Hello.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. I get nuts.
With your host, Phil Grande.
Bye.
Thank you for joining me in my podcast. Well, we're entering Easter. And it's interesting how Wall Street has been operating the last couple days or weeks. It's really disgusting because what's happening is people are getting crushed in the stock market when they shouldn't be getting crushed at all. They should be doing well. But the problem is they don't explain to the folks what the market's doing because they don't want them to know, because their interest is, hey, we're going to take care of ourselves. Give me an example. When we had on Monday that big drop in the market, then Tuesday we turn around and have this big reverse. And because, again, Trump repeating what he did the week earlier, that everything's going to be okay with Iran. But what happens is Wall Street starts crowing about, boy, this is a great market opportunity. Get in and buy. Start buying. We got a real rally going here now. And so the war's over. Things are good. Buy. And it makes you sick because they're bringing people into the market. They don't understand how the market works. And they're going to lose money because this is a short covering rally. That's all it is. Now, you got to understand, there's a short covering rally, and then there's a key reversal. But the short covering rally never, ever is sustainable. You always lose money because when you have a short covering rally, all that's happening is everybody who's been shorting now got trapped and they're getting crushed shorting. They quickly start buying their stocks back. And then Wall Street's saying to the people who are out of the market, they go, you better get in right now because you're going to miss this whole rally. We got a whole new bull market rally. No, we don't. That's a bull-faced lie. You don't have a bull market rally unless you have the, you got to have, first of all, the institutions, the 13 institutions with their powerful balance sheets participating, buying stocks. So they're not buying stocks. So as people see what's happening is the market's going up for the wrong reason because people are covering their short positions. And as the market starts going up, Wall Street starts peddling this thing. You're going to miss this new bull market if you don't get in and start buying right now. Well, there's not one short covering rally in history that's ever sustained itself. It's impossible because you have the same money, no new money. You have the same money, you shorted the stock, and now they get trapped. The stock's going up against them. They're losing all kinds of money. And now they start quickly covering their short position. So the same person who sold the stock short is the same person who's buying the stock back to stop the bleeding, and the market's going up. Well, the problem with that is when people see the market going up, these people on TV, these financial shows should be warning, don't go into this market. It's not sustainable. The only way it would be sustainable is if we can get the institutional money to come out of the bond market, investment grade bonds especially, where they're parked $8 trillion. Imagine $8 trillion in the institutions in investment grade bonds, and our $22 trillion in treasuries. So what's happening is people are listening to the jibber jabbers on TV saying, I better get in quickly here. I'm going to miss this whole new bull rally. There's no bull rally. It's the same people who shorted are buying. Until you get these institutions in there buying, this rally will never hold. And that's what people don't understand. So, they fail to explain, as I say, key reversals don't work. They never have. The only thing that a key reversal does for you, when a market's going straight down, turns around, goes straight up, the reversal, it gives you a great opportunity to identify if the institutions, who remember, it's the institutions, the 13 balance sheets that are powerful that drive the market. And unless they're participating and they're in these safe bonds, the market can only go up until they run out of fuel. And how do they run out of fuel? Well, let's just pretend there's only 10 people in the whole market. So you got 10 people who are driving the stock down, they're shorting, and now the 10 people are getting killed, they have to buy their stocks back. So when they buy their stocks back, that's it, the fuel is gone. So you have this pop, and like this rally only lasted 2 days. 2 days. And the other thing you need to know is that when you have a rally in the market, you got to have some tests. Now, one of the biggest tests is on Monday, when we had that big drop in the market, Tuesday, we had this big rally. That's called a reversal. But is it a key reversal? No. Why? Because one is that we didn't have the right leadership. You need the right leadership. You need the cyclicals to lead the market. But it wasn't cyclicals leading the market. On Tuesday, what was leading the market was tech stocks, AI, and the mag stocks. They were leading. That's the wrong group. And then what happened? Everybody gave it back. The market was up 1,200, more than 1,200 points. And what happened? The market closed down just up 200. Because once people stop buying their own shares back, the fuel is gone. Where does the fuel come from the market? Well, let's talk about that, because most people don't even understand how the market works. So, and it's interesting because all they do is they think, well, I'll just listen to CNBC and I'll listen to Fox Business and I'll just do what they tell me to do and I'm going to make a lot of money. After all, they're on TV. They wouldn't be on TV unless they were really smart. Really? Well, they're not there to work for you. They're not there to help you. They're there to help themselves. So how does the market really work? Okay. So we know in 2008, the market crashed. Why? Well, we know all the reasons for housing and all that. But the other side of it in 2008, people lost money because they were listening to Wall Street preach fundamentals. They're trying to convince you to buy stocks, housing, and everything else because they're telling you stories. They're storytellers. Fundamentals is their prop. So all the fundamentals they're using to tell their stories, to make people excited to buy, was all phony. And that's why the market crashed. And I think I told you before, remember, the same thing happened to the newsletter industry. A $15 trillion newsletter industry, it collapsed to $5 billion in 2008. Why? Because same thing. The newsletter industry is based on fundamentals and telling you stories. And everybody lost their shirt listening to the fundamentals and the stories. So that's a big problem. So in 2008, to fix the market, what did they do? Well, the Fed came in and said, look, no more of this. We can't go through this again. We can't keep on letting Wall Street tell stories and fundamentals. Look where we are. We lost $8 trillion and people are losing their home. We can't do that. So here's what we're going to do. We're going to take and print $13 trillion. We're going to put the $13 trillion in the institutions. That's 13 balance sheets, or 12 institutions. That's 12 major institutions. So what happens is that injection of 13 trillion, remember, it was just printed. They didn't borrow it, they just printed it. So that printing of 13 trillion that went to 12 major institutions, that injection expands the balance sheet, a powerful balance sheet, 13 of them. And that power that gives them the ability to move cash, to move money through what they call pipelines or 7 channels to purchase stocks. Now, as it goes through that pipeline, you need speed to push it through. But what if yields are high? Well, then the pipeline gets clogged up and money doesn't get through to buy stocks. So you're screwed. So you got to have low yields, okay? That's fast money. But look at the yields now. The yields keep going up and up and up for the wrong reasons. So what's happening is, until we get the institutions back into the game, and until we get yields low enough that can push money through these pipelines to buy stocks, I don't care how much money these institutions have, trillions and trillions of dollars, they're not buying stocks. Why would they? They're buying investment-grade bonds. They're buying treasuries. They got 8 trillion investment-grade bonds, 22 trillion in bonds, and they're not moving. So every time you get a rally going up, like on Tuesday, stay out of it. Or at least if you're already in the market, sell into it, take your cash. But how many people on Tuesday were in there buying stocks like crazy, buying on the dip? A whole bunch of people. And they gave it all back. Because unless you have, again, the way the stock market works, you got it. The only thing that will move the stock market up is institutions, the 13 balance sheets. They have all the power to push money through the channels to buy stocks. But if the yields are up, they can't get the money through the channels, and that's what you're seeing today. We were up yesterday 1,200 points, and then we're only up 200 points because they can't get the money through the channels because the interest rates are up. Now, if the interest rates are up for the right reasons, that'd be good, but they're not up for the right reasons. So high yields slow the money that's going from these institutions through the pipeline to the stocks they want to buy. That's why you don't see that's why every time you see we have a rally, it fails. So what you want to find out when you're trading is this: when the next time the market goes down like it did on Monday, goes up on Tuesday, you got to say, well, is this a key reversal or not? You have to test it. You got to test it to see if it's a key reversal. And when you test it, you find out it's nowhere near a key reversal. Because again, you got the wrong leadership. You had tech instead of cyclicals. And the money, and also the other thing that happened on Tuesday, they needed to see on Monday rather, they needed to see on Monday 2 things happen. Okay, they want to see if when we took out the low on Monday, does big volume come in on that low? If big volume comes in, it means the institutions are pulling their money out of the bond market and putting it into the stock market. So that didn't happen on Monday. Also, you want to make sure that you want to make sure too that the S&P broke down through that intraday low, took that intraday low, and then you pushed the rest of the sellers out of the market. That didn't happen. So when that rallied, that crashed on Monday and rallied, you'd have known that that was a head fake rally, and when it hit 1,200, it wasn't going to hold because we didn't have the right stocks. We had tech instead of cyclicals. We didn't, during the test, when the intraday low hit, we didn't see a big volume increase, which told us that institutions are switching from their bonds to stocks. That didn't happen. So it failed 3 tests. It had the wrong leadership. The S&P didn't break down through the intraday low to get rid of the rest of the sellers. And when we hit that low, there was no big volume increase. So smart money started to short the minute that the market was up 1,200 points. That's what we did. So when people get in the stock market, they don't know what they're doing. They have no idea. All they do is follow what the jibber jabbers on TV say. You can't do that. You'll get killed. Now remember, the next time you get a big rally in the market like we did Tuesday, check and see if the cyclicals are leading. If they're not, then let it rally, sell into it, turn around and short it. It's not hard. But stop listening to Wall Street and the jibber jabbers and continue to lose money. Well, we don't do that here at Phil's Gang. Okay? See you on the charts.